Let us get started with day 2 of 13th edition of BIPC. So it's very, very early in the morning, so thank you so much for coming. And let us get started with session 3. And session 3 is titled Financing Solutions for the Global Ports and Maritime Sector. So I would like to introduce our speakers as well as panelists and moderator. So, we will have wonderful 4 presentations as well as panel discussion. And let me invite Mr. Tim Power, Managing Director of GURI, as well as Ellen Gray, CEO of Sentient Ports, as well as Professor Liu Sang-min of Donghua University, and our moderator, Yeshim Ellen Kalyalar, advisor at ADB. So please welcome them with a big round of applause. 네, 여러분 큰 박수로 맞이해 주시면 감사하겠습니다. 네, 감사합니다. So I will turn the microphone to you. Thank you.
Good morning, distinguished guests, ladies and gentlemen, and welcome to session 3 of BIPC's 13th anniversary session. I'm delighted to be joined by an August panel today, and we will be sharing with you the critical financing challenges facing the global port and maritime sector while exploring solutions that can unlock growth, sustainability, and resilience in the maritime sector. As the industry navigates digital and green transformation mandates and evolving trade modalities, access to financing has emerged as both a bottleneck, a significant one in some cases, and an area ready for breakthrough, innovative approaches. Our August panel will explore emerging opportunities across 4 key perspectives. To my left, Mr. Tim Power, Managing Director, GURI, will provide a market overview and identify emerging areas requiring attention. Online, we will be hearing from Noel Hasegaba, Chief Operating Officer, Port of Long Beach. And with us today is Captain Ellen Gray, President of Sentient Ports and the former President and CEO of Halifax Port. We'll discuss how ports have engaged stakeholders to enhance productivity and sustainability while maintaining financial viability. Jens van Ipperzele, Managing Director, and Rajesh Subramanian, Director of Transport and Logistics based in Singapore, APEC, from the ING Bank, will be joining us online to present the commercial banking perspective. Following these presentations, Professor Sang-min Ryu of Donghua University will share his insights drawing on his impressive career as a policymaker and academic as he joins Tim and Alan for a panel discussion and audience Q&A. Without further ado, Tim, the floor is yours.
Good morning, ladies and gentlemen. To wake you up, let's talk about money. It's our favorite subject. I'm going to talk about the fundamentals of the ports business and the implications of those fundamentals for financing. I'm just going to allow 1 minute for the technician to fix the picture so it's my presentation showing, not a picture of me. No, you can't do it. Okay. So we start with fundamentals. How does this sector actually work, and what does that mean for its financial performance? Secondly, we're going to look at the financial performance of the container terminal sector, which is the one that we in GURI monitor most closely. We're going to talk about the investment needs for building capacity. And then we're also going to talk about the challenges arising from financing decarbonization in ports. So let's start with the fundamentals. The first thing about ports is, obviously, they are essential infrastructure for trade. Trade simply cannot move without ports. It is therefore intimately connected with gross domestic product of the host country, and it is a sector that is highly regulated with very large barriers to entry. So in other words, it is not like shipping. Shipping is a highly competitive marketplace with low barriers to entry. If you can buy a ship, you can get in. Ports is not like that. As a result, the characteristics of the port market are stable, long-term cash flows, and you saw that in the presentations yesterday. A very, very important point is that market demand for port services is very inelastic to price. If you think about what is the port cost in your smartphone or your pair of shoes, it is infinitesimally small. So changes in port costs really do not affect underlying market demand. And this is one of our main contentions, is that the trade can afford to pay for ports. Last point is that ports operate in a very concentrated market in most places. Busan may be actually one exception, but in general, you are working in small local oligopolies. All of these things mean that the port's the competitive environment for ports is benign, and therefore financial performance is generally attractive. When we look at ports and terminals, we look at two things to determine attractiveness. The first one is market concentration, and the second one is capacity utilization. If you have a highly concentrated market with high capacity utilization, as we in English would say, it's a license to print money. If you have a highly fragmented market with low capacity utilization, it's a disaster. So when you're looking at markets and thinking, what can you finance? This is a very good guide to what's going to be bankable. I'll give you a specific example. After the great financial crisis, you remember that there was a huge contraction in cargo volume in ports. In St. Petersburg, for example, cargo volume fell by 40%. But in St. Petersburg, the tariff did not drop. And that is because it was a duopoly, two operators in the port of St. Petersburg, and I'm quite sure that they met over a glass of vodka and they said, Nikita, we're not going to drop the tariff. And that's what happened. In Busan, however, where you had a highly fragmented market, also contracted volume, the tariff crashed, and it took years and years to recover. So these are just examples of this phenomenon. Let's look at the financial performance this is first half 2025. First thing is volume. You know, how do you make money in a port business? You make it by handling cargo. So you can see that all of our, except a couple of our covered companies, are all growing. And most of them are growing really fast. First half container volume growth globally was over 5%, which was surprisingly high. So that is great. We track the earnings, operating costs, and profitability of container terminal operators. And these charts are indices of revenue per TEU, cost per TEU, and net earnings per TEU. And this is going back to 2020. So what you can see is that there is a pretty continuous rise in average revenue. And in the pandemic, of course, a lot of that was related to boxes sitting for a long time in the terminal, paying storage. You can also see, though, that costs went up too. Inflation was high, operating cost rose because of operating inefficiencies. But the net effect was increased profitability during the pandemic period, a dip in 2023, and then rising again. So you can see that in terms of earnings, this sector is in a very good position. Return on invested capital varies enormously, but it is all positive. You can see a number of these operators across different parts of the world are at around 5%. It's not very exciting, but it's still positive. Some are fantastically profitable. ICTSI, Westport, Santos, Brazil, generating huge returns on invested capital. And the balance sheets overall are strong. The average gearing debt-to-equity ratio in our covered ports, 75%. So there's plenty of financial capacity available in this sector. Okay, so we're talking about financing, we're talking about investment. What do we need to invest in? Well, the first thing we need to invest in, obviously, is capacity to allow us to handle growth. Cargo volume growth, we estimate, is going to be at around, on average, 2.5% to 3% per year. And we need to make sure we have the capacity available to handle that. Capacity utilization in container terminals, the ideal level is around 70%. It means you are sufficiently well utilized to make money, but operations are efficient. When utilization goes to 80% or above, you find that yard operations become less efficient and your average operating costs go up. So 70% is the magic number. And you can see that that is more or less where we are now, but that is a global average. There are many places where utilization is much higher, and of course, many places where it will be lower. But you can see that based on the expected development of capacity, we are going to have a capacity utilized around 70%. So globally, that's good. What that means, however, is we need to keep growing with the market. So we are expecting 2.5% annual, on average, capacity growth in the period to 2030. And that means another 170 million TEU of capacity. Sorry, I can't read it down there, it's too small. 170 million TEU of capacity needs to be added. Drewry has a port project monitor where we record the status and development of all port development projects globally. And this is our picture of the capacity that is planned in different regions of the world now. You can see that South Asia is the biggest area for investment, and that is not a surprise. Southeast Asia is also a very big area for investment. Again, not a surprise. Maybe more surprising is the amount of money that is planned to be spent in the east coast of North America. But you can see across all global regions, there is significant investment required. So that is, sorry, and I need to tell you what the amount is. So 200 billion, ladies and gentlemen, is what's needed to fund the capacity development that I've just shown you on that slide. Sorry, just come back to one point. There is huge appetite in the investment community for commercially viable port assets. You're all aware, I'm sure, of the current transaction going on between TIL, MSC's terminal arm, BlackRock and Hutchison. That transaction is $22 billion. If you need any demonstration of the interest of the financial community in the port sector, that's it. BlackRock plans to invest billions in the port sector, and there are other infrastructure funds who are just as interested. So commercially viable port businesses have no problem raising money. When it comes to decarbonization, that is going to be probably more difficult. This is a slide showing work we did for the European Bank of Reconstruction and Development and IMO, and we said, how difficult is it to finance port decarbonization? Most of it, in our view, is actually quite easy. Through concession fees, through user fees. As I said earlier, the trade can afford to pay. The only thing that we felt could not be financed easily because of high risk is new fuel. And that's because nobody knows what it's going to be. I won't go through this list because doubtless we'll be coming back, but what this tells you is there is a huge range of financial instruments for commercially viable port financing. However, for less developed countries, it's much more difficult if they're not commercially viable. However, there are options for them through loan guarantees or maybe direct subsidies, various multilateral agencies who can all help to contribute. And that's what we're going to be discussing later. I will leave it there, ladies and gentlemen. In the interest of time, no need to go back to the summary. I'll hand back to the moderator. Thank you.
Thank you very much, Tim, for your insightful presentation. Allow me to then take the liberty of summing up very quickly your insightful comments. The global port industry is demonstrating remarkable resilience, as we can see some of the numbers that you've kindly shared. Stable market fundamentals, steady earnings growth, it seems, and substantial investment pipelines with quite a lot to look forward to in South Asia and Southeast Asia as the new growing markets. And the operators, however, are now facing a dual challenge of maintaining operational efficiency in concentrated markets, and increasingly so, as we've heard over the last 2 days, while navigating the complex transition to decarbonization, which poses both interesting opportunities for returns and notable financing disparities for commercially viable ports and those, of course, in developing regions of the world, including in the Asia-Pacific region. On that note, we will continue with a presentation from Noel Hasagaba, citing the experiences from the Port of Long Beach and how they have been able to cultivate stakeholder support to maintain their growth trajectory. Please.
Hello, 안녕하세요. My name is Noel Hasagaba. I serve as the Chief Operating Officer at the Port of Long Beach. It's a pleasure to join you virtually at the 2025 BIPC. So excited and so grateful for the invitation by the Busan Port Authority and my friends there. Today, I would like to contribute to this panel conversation titled From Bottlenecks to Breakthroughs, Financing Solutions for the Global Port and Maritime Sector. Let me start by telling you a little bit about the Port of Long Beach. Each year, we process approximately $300 billion in trade, and that puts us as the second busiest seaport in the US. For the last 7 years running, Port of Long Beach has been voted the best West Coast seaport. And this year, we received the extra honor of being ranked the best green port. And we're so excited about that because 2025 marks the 20th anniversary of our groundbreaking green port policy. Now, today I want to share with you some examples of projects that we've delivered and tell you a little bit about how we finance them. We are a landlord port, which means that we develop land and we build to suit in partnership with private sector companies. And we enter into long-term leases that our private partners in turn manage and operate. Just in the last 5 years, the Port of Long Beach has delivered some major projects. One of them is what we call today the Long Beach International Gateway Bridge. This bridge was necessary in order for us to allow larger vessels to transit and access our back channel, and it widens the roads in either direction to allow more commuter and, just as importantly, truck traffic to pull more containers across this bridge. This bridge was developed at a price tag of $1.5 billion US. It was a partnership between the state and federal government. We received grants, and the Port of Long Beach contributed about 2/3 of the total cost. But this is an example of how different jurisdictions at the government level came together to deliver a project of national significance. This bridge by itself each day carries 15% of the nation's goods. The other project we delivered recently is what we call the Middle Harbor Redevelopment Project. We took two aging piers and we combined them into this mega terminal that is the new home of Long Beach Container Terminal. This terminal has a throughput capacity of 3.3 million TEUs and is considered the greenest and the most advanced terminal operation anywhere in North America and possibly the world. This also came at a price tag of approximately $1.5 billion US. And it was delivered in a partnership where the Port of Long Beach entered into a 40-year lease, and our partner also contributed capital above and beyond the $1.5 billion for the civil works. And together, this $2.2 billion redevelopment project yielded the Port of Long Beach's largest terminal to date. That's an example of a traditional public-private partnership where the Port of Long Beach finances a part of this and recovers its investment over a long-term horizon. Now, over the next 10 years, the Port of Long Beach has the most aggressive capital infrastructure spending plan of any port authority in the U.S. We intend to spend $3.2 billion, and that is going to enable us to continue to build for the future and continue to add value to the overall supply chain. We know that the key to our success is to develop infrastructure that injects resiliency, but it also brings additional value to all of our partners across the supply chain. And as you look at the next chart, you'll see that most of that spend is going to focus on rail. This is very important because as our market share continues to grow, just in the last year, Port of Long Beach processed 9.6 million TEUs. In the coming years, we expect that throughput to continue to grow. We need additional rail capacity so that we can move those containers directly from the container terminals into the key inland points through rail. We're also deepening our channels, however. As ships continue to grow in capacity, the ability to have these bigger ships access our inner channels becomes increasingly important. And so this channel deepening project is another example of the Port of Long Beach partnering with our federal government partners. This $320 million project will be co-shared and will be co-funded by the federal government in the United States and the Port of Long Beach. Going back to rail for a moment, the Pier B on-dock rail support facility is the centerpiece of our rail investments. This project will dramatically increase our rail capacity inside the port. We're literally building the largest rail yard located inside a port that will be larger than most rail yards outside the port. And this will dramatically increase the capacity of our terminals to route more intermodal containers. And you see on this image, last year, we did a groundbreaking event that included the then Secretary of Transportation. And this truly was a partnership between the state of California, the U.S. federal government, and the Port of Long Beach. We received from the state and the federal government partners in excess of $600 million. And as you can see there on the chart, this project has a total price tag of $1.8 billion, and about a third of that is going to come in the form of grants and funding from the federal government, the state of California, and the county of Los Angeles. I mention this project because our partners in the rail sector are also investing in their own infrastructure outside the port. And these projects, as they're built out, will be synergistic. It will enable us to maximize the advantages of having this rail yard inside the Port of Long Beach, commensurately with the rail yard that, in this case, BNSF Railways is building through its Barstow International Gateway, a more than 4,000-acre site. On the next slide, you'll see that much of these projects have been supported and funded by many partners, locally, regionally, at the state level, as well as the federal government. And that level of investment really enables us to deliver the infrastructure and the projects we need to make our port more competitive, more resilient, reliable, and even sustainable as well. And that's the other major focus of our investments. Over the next several years, we're going to be using the $635 million that we've received in grants so that we can invest in our transition to zero emissions. At the Port of Long Beach, we have two major goals: zero emissions cargo handling equipment by 2030, zero emissions trucks by 2035. Grant funding from the public sector, both at the state and federal level, are increasingly important. But we're also partnering with the private sector. We're partnering, for example, with 4 different companies who are partnering with us to develop and install charging stations in the port that will enable the transition of our motor carrier partners. And to date, the Port of Long Beach has 150 charging stations. Over the next 2 years, we plan to double that number, and all in an effort to make sure that we're enabling our transition. And let me end with another project that's very important. One of our terminal partners, ITS, has partnered with us to upgrade and boost their capacity by 50%. This $300 million project is going to enable ITS Terminal to increase their capacity on an annual basis by 50%. And what we're doing with ITS is we're filling in the second half of the slip. And you'll see here that we're adding nearly 20 acres, 2.5 million cubic yards of sediment will be used to fill that half of the slip. And that $365 million project will be a partnership between the Port of Long Beach and ITS and its parent company. These types of partnerships are what enable us to add value, expand capacity, and make our infrastructure more competitive. And finally, as we transition to zero emissions, we need the power. We need the renewable sources of energy to power our investments, to power all the equipment that's coming online over the next several years. And this is why you look at our demand for power, we expect it to grow sixfold. And this is why the Port of Long Beach has taken a bold step in the last 2 years to help the state of California meet its goal of 25 gigawatt power and offshore wind by the year 2045. But just as importantly, this project will help the United States of America become energy independent. And energy security has become a priority for the United States. And by building out this 400-acre site of landfill, we're literally building the largest facility in the U.S. to assemble floating offshore wind turbines and enhance U.S. energy independence. And this will come at a price tag of approximately $4.7 billion US. I leave you with this slide because it is the reason why we continue to invest so aggressively. We recognize our role as a port authority as a massive economic engine, not just for our local communities and the region, but the entire nation. And these projects that we deliver in partnership with our government partners, with the private sector, are what propel us and power our ability to continue contributing jobs and spur economic activity locally, regionally, and nationally. Thank you so much for your attention to this presentation, and thanks again for the opportunity to be part of this panel.
We will be sharing our deep
Good afternoon,
appreciation
everyone.
with Noel, of course, who unfortunately could not be with us, but very kindly recorded his messages. Alan, if I may come to you next. We've heard Noel frame ports as growth drivers through trade and job creation transmissions channels, and we saw very robust numbers of public funding that supported the effort. Staying on the same topic, during your tenure, Halifax increased its return on investment metrics, went through substantial transformation, and as I recall, in 2023, won the IAPH Sustainability Award for Digitalization. What drove this transition, and how did you find it?
Yeah, thanks. And it's always hard when you come on after that presentation, having been in smaller ports, and there's this moment of inadequacy that springs to mind. But anyway, port to port. And the way I'm going to structure this morning really is to talk about two jurisdictions which I worked in. One is Australia, Western Australia particularly, and the other is Canada. Point out some similarities in the way we finance and some differences. I'll go on to how I tackled particularly the challenges in Canada to get investment and push the path on sustainability. So let's start. Western Australia. It's the only capital city port left in Australia that hasn't been privatised. So there's a symbol there going on. And that really, it was only because of a political decision and some nervousness about the purchase of Darwin in the north by a Chinese billionaire. So what happens there as a state-owned port is you're a government trading entity, you have the freedom to operate commercially. However, your shareholder is the government and all your board is government appointees. The interesting thing is you are given a very strict criteria. You are to earn between 8 and 12% return on investment on your assets. Why? Because the weighted cost of capital is around that mark for ports in Australia, and therefore you are required to be financially sustainable and not coming to the government for funding. In addition, you're to give 75% dividends at the end of your year to the government as a handout. So you have a challenge in that you can't retain cash. You're giving any cash you have over to the government. But you have a clear direction on what your financial stability is. Therefore, we fund everything in Fremantle. The only challenge to that is where a political decision, for example, the current one says that the Fremantle port, the inner harbour, is to be shut down and they're to move 20 kilometres to the south to a brand new port. Now, the port's planning had that as a transition, therefore the growth in containerisation would actually fund the transition. The government decided that it was to be a single move, no transition, shut down the inner harbour, open the outer harbour. That turned a project into an $8 billion project outside the funding capacity of the port, and therefore now government's having to try and work out how they're going to fund $8 billion to build a new port and support a political decision. But ultimately what you see in Western Australia is that the ports will self-fund everything they do. Moving to Canada, I had the same impression. They're government trading entities. Therefore, they had an act which said they had to be financially sustainable. When I sat with the board and looked at the financial returns, they only earned, on average across the 17 Canadian ports, 5% return on their asset base. And yet, their cost of capital in Canada is the same as Australia, between 8 and 12%. So therefore, they weren't earning enough income to actually sustain the capital and the future growth. And when I asked the board, how do you sustain capital? They said, we beg to government. So I want to go back a little bit to Jan's comment yesterday about football, and he talked about the relevance to football. Think about it that you have 17 teams in a league, and that's because there's 17 federal ports in Canada, and you all have one mission. In football, that one mission is to win the European Cup. 16 of you are going to fail on your mission. Only one will succeed. In Canada, with the ports, it's the same challenge. We have 17 ports all vying for a very small amount of funding from the government. 16 of you are going to fail. One of you may be successful. So you have to start being imaginative and a little bit more innovative on how you're going to start funding your future growth. And the way I tackled this is in two areas. One is partnerships, and we heard Noel talk about partnerships. His partnerships was very much around partnering with government. I didn't quite have that advantage, so I had to structure things a little bit differently. And that was around creating partnerships with PSA, CN, looking at ways to structure leases in such a way that they would fund future growth. And I had to structure it and so it was commercially viable for them, but it was about how could we get them to fund future growth. The other is, if you want to win funding out of government, I discovered that partnerships had more power than going on your own. If you could demonstrate where you had a volume of partnerships across other regional areas like municipal and others, or small companies and public-private, if you could demonstrate that, you were more likely to get some additional funding out of government. So an example of that is when we wanted to fund $52 million in decarbonisation projects across the port. There was no way I was going to get that past the board, and I'll explain a little bit more about rate of return, but 52 million investment for a small port on decarbonisation was going to be a challenge. We put together 12 partners to do a very ambitious decarbonisation project, of which we only spent 6 million. The government ended up funding 25 million towards that project because of the partnerships across multitudes of private sector and government departments. So it's that partnerships that allow you to leverage other people's money and a small amount of your money to get larger returns in the end. And I'm going to finish off with the other part where I had to change the narrative around the way we spoke about rate of return. And what we looked at is most people, when they're talking rate of return, talk about it as a business sense. So I invested this much capital, how much does the business get in return? But given both in Australia and in Canada, our legislation actually said we were required to drive economic development in our region. That was our mandate. So I changed the narrative. How could I demonstrate to government that we were driving economic development through decarbonisation? And the way we looked at it is to say, I wanted to maintain my economic throughput, so maintaining the port's $720 million uplift in economic contribution. I wanted to enhance our sustainability, and I wanted to look at what was the net gross value added improvement. Now, gross value added is saying, this is what I positively contribute to the economy, but because of the social impacts, because of the environmental impacts, this is the negative impacts I do. So they're actually costed out. Quick example, if the government spends $150 million on respiratory illness due to particulate matter, and 15% of that particulate matter is from the port, then 15% of that $150 million I allocate as a negative impact. So then you get a lower figure. So you start with a baseline where it's 720 million positive, but the social impact is minus 28 million, and you had a minus 58 million on the environmental impact. So the net GVA becomes 634 million. After applying capital to remove the decarbonisation negative impacts, so the particulate matter in the air and the pollution, I get an uplift in GVA. And that uplift there is approximately 59 million in an annual year. So you can see that there's an investment that creates an uplift in the economic impact I'm creating. So baseline on a 20-year MPV, you get an uplift of 880 million. For, in this case, what I planned through the modelling was a $200 million investment. So you can see that's a rate of return from a GVA perspective of 400%. A very different argument when you're coming to government and saying, my role is to drive economic opportunity in a sustainable way. Here I am driving it through improvements in sustainability. I'm driving changes, and I have a positive uplift and a return on that investment for you. So I can either give you the money, or you can give me money, and I can multiply that out through economic improvement. It's a change of the narrative, and it allows you to get on board. There really is a change in discussion when you start talking this way, rather than from a business-only sense. So, in summary on that, 200 million investment, reducing decarbonisation, and we're maintaining the sector relevance through supporting integrating sustainability and investment. So it's a critical pathway, but the reality is the only way in places like Canada, where even though you're in the Western world, you're in a highly competitive market with the US, you have to be innovative. But one way to be innovative is create the partnerships and then change the narrative in the way you're talking. Thank you.
Thank you very much, Alan. Change the narrative and build the partnerships. Framing ports both as businesses, which they are in a competitive market at that, and as well as framing them as facilitators of multiple co-benefits to align different stakeholder interests and targets to mobilize additional sources of financing. I also would like to pick up one of your earlier points on the importance of ensuring there's agreement on the phasing, sequencing of the change during transition among different stakeholders to ensure that it's as less disruptive as possible to operations and, of course, to keep the costs down. Thank you very much. Next, we have another recorded intervention from ING Bank. Two colleagues will be joining us. Could we have the recording, please, to hear about the commercial bank perspective?
Good afternoon, everyone, and I hope you're having a good conference. I would like to thank Jessim from Asia Development Bank to allow us a chance to contribute a few remarks today. My name is Jens van Ieperzelen. I'm a managing director in ING's transport and logistics team based out of Singapore.
And I'm Rajesh Subramanian. I'm director lead for shipping energy transition with the transport and logistics team out of Singapore.
So ING is a Dutch bank, and we have quite a rich maritime heritage, including 4 decades, or over 4 decades, I should say, of ship financing experience. ING is also a bank that takes the transition of its lending portfolio to net zero seriously, where we specifically focus on hard-to-abate sectors such as shipping. As part of that, we are a member of a number of industry initiatives such as the Poseidon Principles, where we are a founding member. And we also engage in advocacy efforts that go beyond the core shipping finance activities that we engage in. As part of that, of course, we've analyzed how shipping's decarbonization can work. And what's become clear to us is that it's going to be a systemic challenge that will require actors along the value chain to cooperate and collaborate to make it work. And one of the things that stands out in that systemic framework is clearly the production of alternative fuels, which might be key to unlock everything else. Rajesh?
Thank you, Jens. Yes, alternative fuels. Now, let's start with the maritime industry. It is a hard-to-abate sector. And to decarbonize the shipping industry will require multiple stakeholders to work in unison to achieve that objective. Alternative low-emission fuels for shipping will be a very crucial part to achieve the net zero objective for the industry. And this does not just mean ships. We're talking here about the entire end-to-end supply chain of fuels. Yes, the ships will drive the demand for alternative fuels, but ports have a huge role to play in terms of attracting the investments and interest in building the supply chain, the bunkering facilities to facilitate the availability and ease of bunkering of vessels which call ports. There are a few mechanisms to do this. Yes?
That's right, Rajesh. And I think green corridors is obviously top of mind and something that has seen quite a bit of attention in the last 5 years or so, I would say. ING is a member, incidentally, of the Silk Alliance, which is a Singapore-centered green corridor that Asia Development Bank also participates in. But more generally, green corridors bring together a constellation of these stakeholders along the value chain, as Rajesh mentioned, and they try to create common purpose and to move the decarbonization of the value chain forward, but in a more narrow way to unlock the green potential that the corridor can create. Now, there's certain takeaways that now that we are a few years in, we can kind of ascribe to green corridors. I think one, there's been an enormous education effort through these green corridors of different people participating. And not so much in the academic sense, but more in understanding the perspective of the other people, because we all tend to be quite entrenched in our views of what the other party should do. There's a lot of finger pointing. I think the green corridors have to an extent address that by creating a common sense of purpose. At the same time, I think we also have to acknowledge that there are other lessons learned, including the non-competitive nature of certain green corridors makes it challenging to move it from a more of a theoretical discussion to actual action being taken, which is not to say that valuable work doesn't come out, but it may not result in something as tangible as stakeholders would want. I think we also have to acknowledge that there has not been a wave of FIDs or investment decisions taken necessarily as a direct consequence of green corridors being in place. I mean, certainly there's been pockets of success, and indirectly it has driven decision making, but it's not perhaps resulted yet in a kind of landmark project that can be directly linked, which would be a good next step. I mean, in general terms, green corridors and the discussion that came out of it show that there's enormous potential, but we need to find a way to unlock it and to move past the barriers that we encountered when we've been engaging as industry stakeholders in these discussions.
And this requires financing frameworks that will eventually unlock investment decisions. As we saw from Drury's earlier presentation, the risk returns for investment in fuel facilities in ports is notably higher. Hence, innovative and appropriate mechanisms need to be found. At ING, the three dimensions that we have identified towards this as possible features that will unlock these investments are: 1, regulation; 2, aggregation; and 3, risk mitigation. When we talk about regulation, as you may already be aware of, for shipping, the IMO has come out with its recent announcements. We will have to wait with bated breath to see how it turns out in October, but nonetheless, the direction has been set in terms of a carbon pricing framework, which hopefully everything coming in place and going in the right direction will encourage the use of alternative fuels and hence investment across the supply chain.
So if I pick up the mantra again, so if that is regulation, which I think creates the necessary conditions in a broader sense, I think in a more narrow sense, we need aggregation as well. And what this means for alternative fuels is aggregation of demand. And this can happen at a number of levels. The most obvious one is a producer of alternative fuels can cobble together enough demand to justify to himself that he can take an investment decision on a new facility. This would be ideal. Similarly, and to parallel that, ports also need to think about when do they pull the trigger on building the fuel facilities and the related infrastructure to enable all of this, to make all of this possible, because that needs to be there. Otherwise, the fuels that are being produced do not have an outlet and ships cannot bunker them. So at that level, there will also need to be a discussion around aggregation. And finally, we also believe that other third parties could step in to help unlock this or to make it happen. And a parallel to that is, for example, the H2 global mechanism in Europe that is being used to unlock investments in hydrogen in a number of creative ways. So this aggregation of demand to give everyone along the value chain, again, the comfort to make the kind of decisions they need to make on investments is absolutely key. At the same time, we also recognize that this is unlikely to be perfect and that there might still be a level of demand risk that will have to be accepted by parties. That takes us to the third part of the mantra, which is risk mitigation. So on risk mitigation, I think we have to acknowledge that the investments we're talking about are extremely sizable. They have a long payback period, and apart from demand risk, there are other inherent uncertainties that investors will face. So this is going to require a fairly bespoke approach to make it happen. I mean, an obvious one in terms of what is needed just to unlock the sheer capacity that we need is we're going to need blended finance, meaning we're going to have to pull liquidity from beyond traditional banking to also include development banks, export credit agencies, state organizations, and other actors, frankly, that are willing to help bring these together into different combinations that give us the kind of liquidity we need to invest in these projects. So that is step one. I think another step that's going to be important is how can we make sure that what we're investing in, when we talk about a sustainable investment into alternative fuels, is sustainable enough. And this may seem trivial, but the actual labeling of the investing and making sure that it meets certain criteria is going to be key to, again, unlock the financing I just talked about from development banks or commercial banks or other actors, because that allows them to allocate funds that are needed, which would otherwise go to other sectors. A key part of this, which we as a commercial bank are quite sensitive to, is to make sure that the capital treatment for these investments, if they are quote unquote good enough from a sustainability perspective, results in a lower capital charge. This is the only way for banks to really put capital to work in the kind of levels that we need. Because if these decisions need to be made purely along commercial lines, it will continue to be a struggle for the reasons that we've already identified. So this is going to be key, the labeling. Maybe finally, there are discussions going on currently about certain frameworks that could help unlock financing as well. They are aiming to an extent at public-private cooperation and to see if there is a kind of methodology that we can arrive at to make all this happen. We are keen to participate in those discussions, and we think they are an enabler. At the same time, we're also strong believers that you need an actual project to look at, trash things out, work out the details, and have real-life discussions to actually move things forward. So these things will have to work in tandem. We need a methodology somewhere in the background. At the same time, we need enough projects, whether they are coming from green corridors or they're new projects, to actually move this discussion forward. I think in summary, that's how we see the landscape and how ship financing and its drivers will ultimately lead to investments in fuel facilities and port infrastructure as well. Thank you.
Thank you.
Again, we will be relaying our deep appreciation to our colleagues from ING, Jens and Rajesh. Unfortunately, they could not join us due to other commitments, but they were able to share some of their thoughtful insights. To name a few, forming alliances and partnerships around a common sense of purpose, regulatory clarity, demand aggregation, which are some of the topics that we've also visited yesterday, and of course, risk mitigation as the means of unlocking financing, which are very encouraging messaging coming from a commercial banking perspective. And these messages are also closely aligned with what we've been hearing over the last 2 days, including in this panel earlier. Next, I would like to turn to you, Professor Sangmin. Based on your experiences as a policymaker and assessments as a researcher and academic, we've heard Jens and Rajesh emphasize the critical role of de-risking measures and non-traditional credit sources, including export credit agencies, development banks, and of course, government, state organizations, in generating liquidity for sustainable industrial growth, growth in the industry, rather. When should governments intervene directly versus allowing private sector leadership to take over in sustainable port development? And what investment mechanisms can align long-term growth policies with market incentives, in your view? Please.
Great. That's a very high-level question. First of all, thank you, presenters, for your very informative and also very insightful presentations. And Yeshim, let me call you Yeshim. Thank you as well for raising such a thoughtful question that balances our discussion today. My intervention would be maybe from the public sector's perspective. I understand your question is essentially about how governments can best crowd in private capital for port development. That has also been a central issue in Korea's own experience. The challenge we face in port development is that port sustainability is essentially a public good, as addressed by Alan, right? It requires not only resilient infrastructure, but also investment in cleaner energy systems and effective digital platforms. Yet the benefits are often diffuse and realized only over the long term. This creates a market failure that the private sector alone cannot overcome, especially under today's conditions of weakening decarbonization momentum and regulatory uncertainty over future fuels. Without government action, the result will be underinvestment. So definitely we need government's active role. In this respect, let me share some lessons from Korea's cases, which have been guided by a specialized legal framework called Act on Private Participation in Infrastructure. First, I think the overall division of labor between government and the private sector was very important. I think it is very similar to LA's case presented by LA authority. The government directly funded the basic works such as breakwaters, dredging, and reclamation, etc., while opening the terminals and other superstructure to private capital. This division reduced the initial risk for private players. Second, Korean government deployed a range of financial incentives. In the early years, so-called minimum revenue guarantees, or MSG, reassured the private investors, but as you could imagine, the scheme inevitably created excessive fiscal burden, and in some cases, it contributed overcapacity. The Port Authority may not agree to this point, but this was a critical lesson in the careful design of incentives. Later, policy finance support was provided by state-owned institutions such as Korea Development Bank, which extended long-term loans and credit guarantees. And in addition, government seeded infrastructure funds, co-invested alongside private investors. Tax incentives were also applied in some cases, including accelerated depreciation. Lastly, equally important, I think, were institutional arrangements, including the establishment of Busan Port Authority and the Incheon Port Authority. These authorities have not only coordinated policies, but also participated directly in investment schemes, helping to reduce the financial burden on private companies. Based on that, Korea succeeded in bringing in not only major domestic investors, but also global operators such as PSA and the DP World. Their participation was essential for financing, operating, and integrating Korea's ports into global shipping networks. Lastly, to sum up, the key lesson from Korea is that incentives work best when they balance risk sharing with efficiency from the private sector. Credible institutions and the shared financing tools are what truly sustain port development. Let me stop here. Thank you.
Thank you very much, Sang-min. Very thoughtful comments. Thank you for those. Looking at not only the contributions by public and private sector and the division of labor, I believe you used the term, between the two, but also to ensure that it does not perhaps impact the market to the other extreme and creating overcapacity at the expense of taxpayer funds, I believe was one of the points that you've kindly raised. We have some questions coming from the audience as well, if I may direct them to the panel. One question is about regulations impacting, or regulations, environmental regulations about shipping and aviation. Considering that they both contribute about the same amount of emissions, around 3% of global GHG emissions, the question is about carbon reduction is a global goal, and it may be difficult to achieve through the efforts of the shipping industry alone. And do you think the shipping industry is facing disproportionately stronger regulations compared to other sectors, including aviation? Alan is smiling. May I start with you?
I think if you're on the raw end of a regulation, you always feel like you're being victimised. One of the challenges I had in the community, particularly in Halifax, is global emissions is just too big a picture for them. You know, people just don't understand how to deal with saving the world, and you know, and these regulations are sort of focused at that. But one of the ways I changed the narrative was to focus on what was important locally. And I think this is where then you can start looking at where these regulations play out. So one of the things when I surveyed community about sustainability, what was important to them, GHG emissions didn't fit anywhere on the scale. And my board said to me, we obviously did the survey wrong because global emissions, we're all going to die. It must be important. But the number one thing for community was health, safety and well-being. And I said to the board, you know, if you fix local emissions to improve safe and health living, then randomly you happen to contribute to reduction in global emissions. So there is a part in every sector that's required. So, you know, you need to be addressing trucking volume and pollution, and you need to be addressing emissions in port. But what you have to be aware of is, with any of these regulations and policies, is understanding the cascading impacts of those policy decisions. And a clear one is coal dining or shore power. I did the work in Halifax that if the same EU regulation came across into Canada, I needed 140 megawatts of energy to power all the ships that were in port. At 45 megawatts, I blacked out the city of Halifax. The grid capacity in most countries is unable to handle it. So you have a regulation up here which isn't there. So you've got regulations coming in shipping at the moment, which are probably aspirational, and the technology and some of these other things aren't matching. It doesn't make them wrong, but if you're going to apply regulation and you're going to apply policy, you need to understand what the cascading impacts that is, and the reality and government's responsibility in addressing some of those. If you want ships to go to coal dining, governments need to address grid capacities. You know, it's just a fact. Ports can't do that outside the port. So again, if you're addressing fuel and you want shipping to move across to fuel and you want to put a regulation in around fuel, governments need to assist on how those markets are going to be developed and how that regulation is going to quickly come into place to support refueling vessels in port. So it's understanding the full chain.
Thank you very much, Alan. Excellent points in terms of looking at what's tangible, what people can see, and the fact that any of these measures have co-benefits, and to drive those co-benefits home, while we're looking at shipping driving the global value chains, productivity and efficiency gains in shipping actually drives also climate goals and supports jobs, as we've heard from Long Beach and Noel as well. Tim, would you have some thoughts on this?
I would. My basic position in all of this is shipping demand and port demand is very inelastic to price. I just repeat what I said earlier. What percentage of the cost of your smartphone or your shoes or your tie or your suit or your dress are shipping or port costs? Very, very small. So coming back to this point about the cost of new fuels, you remember in the pandemic, in 2021, container shipping rates in our Drewry World Cargo Index went to $10,000 per 40-foot container. And the trade grew by 6%. What this means is that the market as a whole can afford all this. There should be no overall resistance to adopting new fuels, even if they are more expensive, because the total cost in terms of the landed cost of the goods that we are moving, will still be very small. So, in a way, I find the whole discussion about this very illogical. And the key point then is, as Jens said yesterday, regulation. If you have clear regulation that gives you predictability, that means that ship owners will change their behavior, and that will create demand for new fuels. If we don't get the regulation, let's say in October, if I'm a small ship owner, I will say, if I tried to do the right thing and move to alternative fuels or have energy efficiency measures, I will kill my business. So this regulation has to happen, and trade can afford it. Frankly, it's an argument about nothing.
Thank you for your thoughts. May I come back to you, Sang-min? We heard the importance of regulation and pathways of development from Tim. When we're looking at ports, obviously they have public and private components. And we've also heard from Alan earlier that it is important to look at ports as an ecosystem. It's not enough to look for port infrastructure development if the necessary energy connection is not there, if the grid cannot sustain the energy requirements, for instance, we particularly see this in the cruise terminals, for instance, with the increased size of the cruise vessels and the demand they put on the grid and the impact they have on land, on jobs, on people's lives in the cities they dock at. Where do we strike the balance?
As you might know, I have already retired from the government, so it's not my business. But when I worked at the government, I always faced extreme complaints from the private sector about the regulation, the level of regulation. But personally, I prefer the incentive system rather than just regulation schemes. That is my basic question. In particular, I would like to add just one point. It is about the future fuels. So I know that these days onshore port supply and or bunkering systems for the new future fuels. These infrastructure should be supported strongly by the government, if possible. I think there is very, very important part regarding the port development to transition into greener ports, and yeah. Let me stop here. Thank you.
Thank you very much. We are coming to the top of the hour and the end of our session. Allow me to request in 1 to 2 minutes from each of our panelists the one point that we must keep in view for especially emerging markets going forward as the digital and the green transformations march on. May I start with you, Tim?
One thing I would say is be very careful about designing the project and build what you need to create economic value. If you do that, you will be able to fund it.
Yeah, very good point. And I guess I'll take one step earlier to yours, is get rid of wastage. This industry has more wastage in it than you can poke a stick at. It's incredible the amount of wastage we have. And take the time and use digital platforms. It's a small investment really compared to large capital investments. Use digital platforms to optimize what you have. Bleed the assets you've got, make them efficient. Work with your stakeholders in a partnership. I've said quite often to people, if you're a port authority and you behave just as a landlord, therefore your strategic visions are never going to be achieved, because you need the terminal operators to be operating to their maximum efficiency with the assets you've given them. You need your trucking assets to work. You need your rail assets. So sitting there alone with a vision about putting through 3 million TEUs and building another $500 million investment is doomed for failure if you can't get the wastage taken out of the rest of the system. So my view is take the wastage out first, and then to Tim's point, that's going to give you the volume that's going to allow future investments.
I think we already ran out of our time, but if you allow, let me briefly touch on the role of multilateral development banks, especially including ADB. I think port sector in the region, in the Asia Pacific, has been polarized between advanced ports and some smaller ports. If technologies and the knowledges can be shared within the region, smaller ports can enhance their ability to transition into much greener and smarter operations, and these efforts can help narrow the development gap in the region. As we heard in the team's presentation, there are huge opportunities to invest in ports across Asia, especially South Asia. I believe ADB is uniquely placed to make this happen. I think with its convening power, its technical expertise, and its fast-growing financial resources. Let me stop here. Thank you.
Thank you very much. On that note, we have heard a very rich combination of views and thoughtful, insightful comments from our panelists. Leave no one behind. Make sure you cut the fat, focus on the bottom line, start working on it, if I may. Please join me in a very warm appreciation, our deep appreciation for our panelists' very insightful comments. And of course, thanks to our audience for their very interesting questions that they have shared and added to the richness of the conversation. And last but not least, our deep appreciation to Busan Port Authority for this excellent organization that brought us together, and for their impeccable hospitality throughout the conference. Thank you very much. Thank you for your attention.
And of course, why don't we give another big round of applause to our moderator, Yeshim. So thank you so much. Thank you. Thank you. So I always wish this panel discussion is longer. So it was very insightful, and I think all of you agree. So thank you so much. And now it's time for a coffee break. So make sure you enjoy the coffee and snacks that we've prepared in the hallway. And from 11 o'clock, probably, we will get started with the session 4. So make sure you come back soon. 네, 잠시 저희 커피 브레이크 시간 가지도록 하겠습니다. 잠시 후 또 11시부터는 마지막 순서죠. 세션 4 시작합니다. 여러분의 많은 참여 부탁드리겠습니다. 네, 그러면 저희 시작하기 전에 다시 안내 말씀 드릴 예정이니까요. 커피와 다가 즐겨주시면 되겠습니다. 감사합니다.